those who say don't know, and those who know don't say. Brian Kantanka. My undergrad's in statistics and finance, and my master's is in data science. So I used to work for the Federal Reserve Bank of Kansas City as a bank examiner and data scientist.
You are now a small business owner yourself.
So I essentially use data science the first year where I made a significant amount of money to walk away from my job. So the risk to reward is making $3 for every $1 that you risk.
How do you know when you invest?
Pay attention to the news for, because the news can impact that one, because I'll hold that one for days, weeks, maybe even months. The most important thing, I believe, when it comes to investing is knowing when you want to get out of a trade. The mistake people make is when they're holding it, saying, oh, this went up 100%, probably gonna come back down to the average tomorrow. And I think that's where most people make their mistake, is they don't know at what point they're going to get out.
Is discipline and controlling your emotions as it relates to investment?
Yeah, definitely, 100%. People are very emotional when it comes to money. I'm risking $1 in order to make $3. Biggest mistakes you can make, at the end of the day, nobody has ever gone broke cashing out and taking a little bit of money. I feel where people go broke almost always returns to its average in the short term. In the long term, we see stocks go up historically. So GameStop shot up 120, 30%. Within a day or two. The next day, you saw it shoot down almost 50%.
Mentors, books, anything that you think should be out there.
Jim Simmons, who in my opinion is the greatest investor of all time, and you kind of have to get your hands dirty to figure this out. And once you do figure it out, then you can just make money off of it for the rest of your life. Actually, a lot of these YouTube people sell you my course. They're actually making a ton of money. Why would they care about your,
You're promising the life that you're living right now.
A pattern in the market that nobody else knows about, and you just keep capitalizing off of that pattern,
You're done.
You can make a ton of money. The biggest consistency that I've found in terms of successful traders versus unsuccessful traders is backtesting.
How do you backtest?
What do you think about crypto in this space?
I actually do like crypto. So I actually do trade crypto.
How much kind of person could potentially make? Give me a range. Brian,
Yes, sir.
please introduce yourself to us. As you know, this channel is dedicated to small businesses. You are now a small business owner yourself. Mm-hmm. But prior to that, what have you done?
Yeah.
What are the sharpest people I know here in Kansas City?
Please.
Pleasure to call you a friend, and also glad that I have you on the podcast.
Likewise. So yeah, I'm Brian Kantanka. I previously, before I started my businesses, I used to work for the Federal Reserve Bank of Kansas City as a bank examiner and data scientist. Long story short, essentially I investigated banks for criminal activity, consumer lending, fraud, unfair deceptive acts and practices, things like that. But I was also a data scientist. That's kind of what I'm trained in. My undergrad's in statistics and finance, and my master's is in data science. So I love data. I love research. I love getting into the numbers, and that's kind of what led me to start my small business within the stock market. So I essentially use data science to analyze trends within the stock market, and then I make predictions based off of those trends. And when I'm right, I make money, and if I'm wrong, then I lose money. But I'm right more times than I'm wrong. So.
I like it. I think in any business, it is a gamble that you'd want to put your chips on the table and say that this is the bet that I want to go in, and then you make that decision. If you hit it, you hit it big.
Exactly.
But sometimes there's that potential of loss. I mean, we can certainly get into the business, but tell me a little bit about your experience working for the Federal Reserve Bank. And imagine, I know you left that job to be able to, pursue your dreams as a business owner.
Yeah.
But what I found to be very interesting was you really relied on the experience that you gathered working for the Federal Reserve Bank.
Mm-hmm. Yeah.
Can we call them the Feds?
Yeah. You can call
Okay.
them the Feds. Yeah.
They work for the Feds to be able to actually really design what you're doing right now, right?
No, I completely agree. I don't think I'd be able to do what I'm doing now if I hadn't had that experience with the Fed. Long story short, the Federal Reserve, the economic data it releases, the data feeds it has, all of that affects the stock market significantly. Jerome Powell, who's the chairman of the Federal Reserve, every time he speaks, the markets shift. You know? Every time the Feds release their meeting minutes, the markets shift. So the Fed is incredibly impactful when it comes to the stock market. And I learned that at my time at the Fed, and especially learning what data the Fed releases, whether it's what data the Fed releases publicly. Whether it's housing starts, whether it's inflation, whether it's non-farm payrolls, things of that nature. and just becoming more familiar with the data I have available to me, feeding those into a model, and then looking for correlations and figuring out, okay, when this happens, how does this affect the stock market historically? When Jerome Powell speaks and, this is the situation, how does it affect the stock market historically? So I've been able to kind of find those correlations, but I wouldn't even know where to look or where to start if it wasn't for my experience at the Federal Reserve and really familiarizing myself with the data that the Federal Reserve makes public. There's other federal agencies that have a lot of valuable data, like the Bureau of Labor Statistics. They have quite a bit of valuable data also, but I'd say the Federal Reserve has the most comprehensive public data sets that are impactful to the stock market. I definitely think it was impactful.
So you basically break the data down to the granular level, right? To
Yeah.
be able to actually see even a speech.
Yeah.
One of the conversations that you and I had a few months ago was that you were waiting for a lawsuit that could impact the decision that Apple would make, and that would significantly impact the stock market, right? Or the stock for Apple.
Yeah.
Tell me a little bit more about that and like what in these kind of decisions being made with such information that somebody can overlook could either, help you make money that day or not, right?
Yeah.
Or lose.
Yeah, no, I completely agree. So news events are huge. News affects the stock market incredibly. News is very hard to predict though. So currently I have two strategies. One's a short-term day trading strategy, and one's a long-term trading strategy. With the long-term trading strategy, that's where a lot of the news comes into play, along with the macroeconomic data. I also have a short-term day trading strategy where I'm only in the trade for a couple minutes, maybe a couple hours, but at most one day. So I never hold it more than a day because I don't want to introduce that overnight stock risk. Because with the news, it's unpredictable. A lot of things can happen. Like the president of Iran can die, and that's going to shift the stock market. Countries can declare war. A bunch of events, unpredictable events could happen. Black Swan events could happen, for example. So with my short-term day trading strategy, I almost never hold a stock overnight because I don't want to entertain that risk. Now, the short-term day trading strategy is much more high risk, high reward, but the long-term swing trading strategy where I'm, taking into account news events, taking into account macroeconomic events, that one is the one that I pay attention to the news for because the news can impact that one. Because I'll hold that one for days, weeks, maybe even months. At most, I'll hold it for like a quarter, essentially. And as you can imagine, a lot of news comes out in a quarter. Apple could have a lawsuit. I believe Apple had a lawsuit in Europe that affected its stocks substantially. Apple's been going through it. Apple's had so much issues. And we see it within its stock price. Its stocks pulled back quite a bit over the last few weeks. We're starting to see a little bit of a rebound, but I really do think a lot of the adverse news around Apple, along with their decreasing sales, have really affected that stock specifically. But all of that to say, I do have two strategies. One, the news doesn't really affect it because I only hold it for a couple minutes, a couple hours, at tops a day. The other one, which I'm holding for a much longer period of time, that one is where I take into account the news, I take into account macroeconomic factors, I take into account what the Federal Reserve is doing, the interest rates, what's the job report look like, what's unemployment look like. I take into account wholesale inflation, everything I can get my hands on. And then I feed it into a machine learning model, and it essentially finds these correlations for me and essentially spits out a prediction. And then I use that to do my swing trading strategy.
Swing trading being the long-term strategy?
Yes.
Is that what it is?
Yeah.
Break down the difference between the two for me, and why would someone or why would you, choose to invest in the stock market and expect a result within 24 hours instead of putting it in the long term? Like you said, max a quarter, but
definitely.
What would that make? What's the difference between the two?
Definitely. So there's really three forms of investing. There's day trading, which is very short. As the name suggests, you're only in it for about a day. With swing trading, that's kind of medium-term type investing. So that could be, multiple days. It could be a couple weeks, a couple months. Probably at most, it's going to be a quarter. And then there's investing, which is long-term, where you're looking at the year horizon. The reason why I choose swing trading is because, I'm very young right now, and I can afford to take risks. Obviously, as you get older, you want less risk, but you're probably going to get less return. And the inverse is true. Since I'm younger, I can afford to take more risk and essentially get more reward for the risk. So specifically with day trading, that one's obviously the highest risk, highest reward. So that one actually has expiration dates. So normally if I buy something, I expect, so you can buy calls and puts. I trade options, so they're derivatives of the actual stock. But long story short, what it is saying is that you're going to pick a stock and you're going to make a bet whether the stock's going to go up or go down by a specific time. And normally that specific time is 1 week, and that's my day trading strategy. Even though it expires in 1 week, I plan on selling it within 24 hours, so I'm not going to hold it for the entire day. And the reason why I do that one is because I've also done statistical analysis, and I've found that there's certain patterns that happen on the daily chart that can be predicted. Specifically, I use what's called linear channels and stochastics. Long story short, they're just statistics that help me figure out which direction the asset is most likely to go within that day. So that's kind of the day trading strategy, and the reason I do that is because that's higher risk, high reward, and I'm young. Worst case scenario, I just go back to the job market, I get a job, and then I can make some money, and then go back to doing this, as opposed to older individuals who that might not be an option. They might have children, they might have other commitments. But since I'm young, I feel like I can afford to take higher risk, higher reward type investments. So that's kind of why I chose day trading. And then with swing trading, this is more medium term. So this doesn't have as much reward as the day trading, but it's less risky. It's much more trend heavy. So if you see the stock market's trending upwards like it is now, you can make a bet saying, okay, over the next month, 2 months, it's probably going to keep trending, especially because we're in an election year right now, and almost every single election year is a positive year for the stock market, especially because politicians want it to look good. They're competing for public opinion, and nobody wants a negative GDP on their record as they're applying for an extension in their job. So historically, election years are good years for the stock market, which is why I do swing trading, because it's a little bit less risk for a little bit less return, but it's much easier to predict. So I like to have swing trading there also. And with swing trading, you can put in quite a bit more because it's less risky. With day trading, I only have X amount that I'm going to cap myself at, that I'm never going to really put in more than that in a day because, like I said, these expire in 1 week. So long story short, if what I expect to happen doesn't happen within 1 week, then you lose your entire investment. So if you invest $20,000 into, let's say, a call option for Apple, you have 1 week for Apple to increase in price from where it was when you bought it. But if it doesn't increase in price within that 1 week, you're going to lose that entire $20,000. As opposed to swing trading, where you have multiple, where the expiration date is much further out. That could be a quarter out. That could be 3 months out. So the probability that Apple increases in value at some point within the next 3 months is pretty high. And because of that, you can invest substantially more. Because you feel comfortable that you're not going to lose that entire balance. But options trading is risky because you can lose everything you invest. Options is less risky than futures, though, because with futures, there's this thing called leverage where, long story short, you have to borrow or trade on margin. So let's say, with options, you have to have cash. Well, you can borrow, but most people have cash. So let's say, you invest $1,000 into an options trade thinking it's going to go up. The most you can lose is that $1,000. But with futures, since you're borrowing on margin, let's say you invest that same $1,000, you're borrowing of your own money. You're borrowing, let's say, another $1,000 or $2,000 to leverage the trade up so that you have now $3,000 that you can invest into this asset. Even though $3,000 is bigger than $1,000, $2,000 of that was loaned to you. So if you're wrong, you're in debt. Not only did you lose your entire $1,000 investment, now you're in debt $2,000 because you borrowed that $2,000.
Who's the lender in that transaction?
The brokerage firm is the lender. I don't trade futures. I find them incredibly risky. They're unregulated. I'm not a futures trader at all. It's just not my cup of tea, and I just don't really see much of the appeal for that. So for me, I trade options. I feel it's a nice middle ground in terms of risk. I've back tested it. I know my statistics. I know what's most likely to happen. I know the risks. I can calculate the risks, and I just feel much more comfortable trading options than futures. So,
how does one get into trading options?
You can go to any brokerage. So like you can go to a brokerage, open up a brokerage account, whether it's E-Trade, TD Ameritrade, Fidelity, Charles Schwab, which I believe Charles Schwab bought TD Ameritrade recently. So yeah, you can just open a brokerage account with any of these firms the same way you would go and buy a stock or an S&P 500 index. Most of these equities have options attached to them. So, you'll log into your brokerage. After you create the account, you can type in any symbol. So you can go to Apple, you can go to Microsoft, and then you can buy the actual stock if you want, or you can buy an options contract on the stock. So the best way to think of options contracts, they're kind of like coupons. So let's say there's like a bag of chips, right? Let's say the bag of chips costs $10. Let's say I have a coupon that says you can buy 5 bags of chips for $1. That's kind of what an options contract is. It essentially gives you the right to buy an asset at a specific price for a specific time period. So very similar to coupons. That coupon might only last like a week. Maybe they're doing a promotion. So rather than going to the market or going to the grocery store and paying $10 for the bag of chips, you can come to me who bought the options contract or who has these coupons, and I can sell them to you for whatever we decide. But I only bought them, or I can sell them. Each bag of chips, let's say, is $1 based off the coupons. So for you, if you want to buy these, you can either go to the market, buy it for $10, or you can come to me and guarantee your price at $1. And then, we can work out a deal regarding how much I want to sell it to you for, maybe $5, $6, $7, but it has to be less than whatever the market's charging. So
does that mean it is almost a contract between a seller and a buyer, without the companies? Sure, the company's aware because I'm sure they're the ones that facilitate the options. However, I'm just trying to see the connection between why would a company that is stocks valued at $10 would want to have an option for $1?
Yeah, so it's essentially between the buyer and the seller. So the company's not really involved. So like, let's say, Apple's been around for 50 years. Let's say I bought some Apple stock. I don't know. Let's say 20 years ago, I bought some Apple stock. Let's say I bought the Apple stock for $100. Now Apple is, I don't know, maybe 600, 700. So I have this Apple stock that I purchased at this specific price historically, and I can give you that Apple stock at that price that I purchased it at. And that's essentially what an options contract is. It's essentially guaranteeing you the right to buy a specific asset at a specific price that somebody else owns. So normally every options contract is 100 shares. So I am buying the right to purchase an asset, 100 shares of that asset at a specific price. So that can be through the seller, the person who bought it 20 years ago, or that can be through the actual company, whether they're issuing new shares, whether they have these shares in reserves, because companies have their own shares of their own company, and they can give it to you at whatever price that they want. So that's kind of how options contracts work. It can be between the seller or it can be between the company. The only caveat is it has to be with somebody who owns the actual asset. So kind of going back to the chip example, it would have to be a grocery store that actually has the bag of chips that you want, and that they're issuing these coupons that you can use to get them. You can't just or maybe somebody who got it off the third market or something has the coupons also. At the end of the day, it's really anyone who has the stock and they're able to essentially give it to you for a specific price. That's kind of how it works. But most of the time, it's going to be either through the company. I would probably say most of the time it's through the company, because most individuals don't have 100 shares of a stock, because that's a ton. I mean, if Apple's trading at I don't know, maybe $600 a share, for somebody to have 100 shares of that stock is probably unlikely. But a brokerage firm who, it's their job to essentially have these stocks in free flow, or the actual company of Apple to have multiple, shares of their stock, that's much more feasible. But it can be a person. So
I would imagine a person can hold stocks because maybe they are part of the founding fathers into the organization. Yep. Wouldn't that be the case where they provide you stock option payments along with your salary?
Yeah.
And now you own 10,000 stock options,
exactly.
Right?
Yeah.
So if I was, let's say someone was working for a tech startup is making money, and they decide to go public, and now they have about $10,000 of stock options, right?
Yeah.
So what does that mean? What does that mean? So like maybe it's a broad question, but
Yeah.
fill in with your imagination and try to see ideally if that was to be the case. A company has been established for like 10 years now, making money. Initially, the stocks were is given or
Yeah.
compensated to the employee at
Yeah.
15 cents.
Mhm.
All right.
Yeah.
Per share. Now the company is selling for $1.
Yeah. Yeah, that's fair. So I haven't been in that specific situation, but I'm guessing what happens in that situation is that as you continue to progress with the company, let's say, it's kind of like a vesting schedule. So you work 1 year, you have the option to buy a stock at a certain price. You work for 5 years, maybe the price is lowered and you're able to purchase more. So my understanding of stock options in that situation of like working with a startup and having a vested schedule it's very similar to actually buying stock options on a brokerage, except I believe in that situation, there's a limit to how much you can buy because obviously the founding fathers don't want you to buy 100% of the stocks if you're capable of doing that. So they're probably going to cap how much you can buy, saying you can buy 5% of the outstanding shares, and if you do buy 5%, you can buy them at this specific price. So it is kind of similar to buying stock options through a brokerage, except I'm assuming that there's a limit. Again, I haven't been in that situation, so I'm not certain, but I'm assuming there's a limit in terms of how much you can actually buy.
Yeah,
So.
it makes sense. It makes sense. How do you know when you invest and you're doing, let's say, short-term investments, let's say,
Yeah.
right? And how do you know that this is going to be a company that I want to put money on? What is the risk calculation as it relates to there's a likelihood that I'm going to lose my money on this particular stock versus I'm going to make it in the overall comprehensive
Yeah.
overview of it.
Yeah.
How do you calculate it in your mind and based on your statistics that or models that you've already built to make that prediction?
Definitely. So mostly through what's called backtesting. So it's not like I'm just going in blind and saying like, okay, I think this is what's going to happen. I essentially test this over years historically and say, okay, normally when we see X happen, Y happens 75% of the time. And that's essentially what I'm using to make my decision in the stock market today. And that process of going back historically and testing your strategy historically and seeing if it works is called backtesting. So I've backtested a number of stocks, essentially every stock over $200 billion. And I've narrowed it down to 10 stocks that have the highest accuracy rate with my specific strategy. The highest accuracy that I have is about 83% historically, and that stock is Eli Lilly. Oh no, actually number one is AVGO, which is Broadcom, and number two is Eli Lilly. So long story short, I've tested historically with these different stocks and I've found patterns that present themselves consistently, roughly 80 to 70% of the time. And then there's certain stocks that have a lower percent accuracy, maybe 70%, 60%. But as I'm going into that trade, I know that, okay, historically this has happened about 200 times. Out of those 200 times, only 70% of the time when X happened, Y happened. Therefore, I'm able to say, okay, there's roughly a 70% chance that this move is going to go the way that I predicted, or roughly 82% chance that this move is going to go the way that I predicted. But I essentially do historical back testing in order to get a probability of what's likely to happen next. And then you can set your stop loss saying, okay, I'm going to risk $2,000. If I lose $1,000, then I'm going to, cut it. Or, if I lose $500, I'm going to cut it. But the biggest thing is to know at what point you want to get out. So let's say you invest $2,000. Let's say you're right and it goes up to, $3,000, $4,000. The most important thing, I believe, when it comes to investing is knowing when you want to get out of a trade. So for me, my return, once I make about 30%, that's a good trade for me. And that's where I set my stop loss. So if I'm in profit and it goes above 30%, then I set my stop loss at 30%. If it comes back down to 30%, then, it just sells it. It's a good trade. I'm okay with it. I think a lot of the times people get greedy and, they'll invest 2,000 and they'll say, well, it might be the next Bitcoin. It's going to go up to 10,000. Or let's say my return is going to go up to 10,000. I'm just going to keep holding it, which is one of the biggest mistakes you can make. Like, at the end of the day, nobody has ever gone broke cashing out and taking a little bit of money. I feel where people go broke is when they're holding it, saying, oh, this is going to go to $1 million. I'm just going to hold it. And then it comes back down. Because that's essentially what stocks do in the short term, is that they always return to their average. So if there's a large increase, there's probably going to be a large decrease the next day because it almost always returns to its average in the short term. In the long term, we see stocks go up historically, but in the short term, where I'm talking like daily, you see pullbacks. Like for example, GameStop, like 2 weeks ago, GameStop shot up, I think it was like 120, 30% within like a day or two. It's not a coincidence the next day you saw it shoot down almost like 50%, right? Because in the short term, assets always want to return to their average price. And that's kind of what my investment thesis is built on in the short term. Um, so I think the mistake people make is when they're holding it saying, oh, this went up 100% today, it's probably going to go up another 100% tomorrow, which that's not how it works. More than likely, it's probably going to come back down to the average tomorrow. And I think that's where most people make their mistake is they don't know at what point they're going to get out. So for me, once I make a 30% return on any trade, I set my stop loss. I'm okay with that profit and I walk away.
How did you garner that discipline? It seems as though that's very difficult. I could understand, given your background in statistics, if this is what the numbers are telling you, you should certainly act according to what the numbers are telling you.
Yeah.
I know a lot of people that hope that, like you said, maybe today it shot up 100%. Therefore, I'm expecting it to shoot up another 100% the next following day, and then they end up becoming, they take losses that day.
Yeah.
So is discipline and controlling your emotions as it relates to investment?
Yeah, definitely, 100%. Money. People are very emotional when it comes to money, and that's I'm not going to say I'm perfect, but at the end of the day, I know for a fact what I'm doing is based off of statistics. It's based off of numbers. It's based off of probability. It's not based off of whether, I feel a certain way about a stock. To be frank, like I don't even look at the earnings reports or, a lot of the fundamentals of these stocks. I am purely looking at the statistics. I'm purely looking at the numbers, and I'm purely making investment decisions based off of the numbers. And a lot of individuals call that quantitative trading. Actually, Jim Simmons, who in my opinion is the greatest investor of all time, he was a quantitative trader and he purely went by the numbers. He was a mathematician, a statistician. And in my opinion, he is the greatest trader of all time, even ahead of Warren Buffett. Based off of his returns, objectively, he has made more money than Warren Buffett year over year. His returns were roughly about 50% return every single year that he traded. The reason why, in my opinion, more people are familiar with Warren Buffett is because Warren Buffett has been doing it longer. And even though he's made less returns over a longer period of time is going to add up to a larger sum of money. So for context, Jim Simmons started trading when he was roughly 40, being a quantitative trader and just looking purely at the numbers when he was about 40. He actually just passed about a month ago at the age of 80. So that's roughly 40 years of trading. Across those 40 years, he made roughly about a 50% return every single year, which is insane. And then you can look at individuals like Warren Buffett, who are also extremely talented, have made so much money. But when you look at the numbers, Warren Buffett's returns are roughly about anywhere from 25 to 30% over that period of time. The difference is Warren Buffett started when he was 10 years old, and now he's turning like 96. Wow. So Warren Buffett has been around almost twice as long in the investment world as Jim Simmons, even though Jim Simmons' returns are higher than Warren Buffett, which is why I think Jim Simmons is the greatest investor of all time. And unfortunately, he did pass recently, but he does have quite a few interviews, literature that you can read from him. But all of that to say, Jim Simmons was a quantitative trader who purely focused on the numbers, and he's a mentor of mine and, somebody that I desire to emulate. But yeah, it really just comes down to purely going with the numbers. I know historically, 70% of the time when X happens, Y is going to happen. And I know, let's say 50% of the time when Y does happen, it appreciates, let's say 30 to 50%. Therefore, I'm going to set my stop loss at 30%. Once I make my 30%, I'm good. But if it goes up to 50%, that's awesome. I might do a trailing stop loss to try and capture some of those additional gains. But at the end of the day, my goal is to make 30% and then I'm out. And then normally I'll only risk 10% of my capital to make 30%. So I'm risking $1 in order to make $3. I like to think of it in terms of percentages. But for those who think of it in terms of dollars, that's kind of the risk to reward is making $3 for every $1 that you risk. So.
Beautiful. With any books that you've read that really helped you strengthen your position as you jumped basically headfirst into this venture? maybe at first is not an accurate description, because I know you've done a lot of studies to such
Yeah.
trials. Even
Yeah.
before you decided to do this interview, you
Yeah.
said that give me a hearing manual.
Yeah, exactly.
Let me make sure that I'm actually having the processes right,
Exactly.
and also put myself in a position where I can confidently speak to the results that I've yielded. So I really appreciate the fact that
Yeah.
you're taking a step back, especially for a young guy like yourself,
Yeah.
thinking of a lot of things before you can actually put it out there.
Most definitely.
But just going back to the original question, mentors, books, anything that you think should be out there.
Yeah, there's a saying that I really like. It's those who say don't know and those who know don't say. So to be honest, there's not a lot of comprehensive literature that tells you everything in one book. If it was, everyone would be buying it, everyone would be doing it. And to be frank, most of the really wealthy individuals who have figured out the stock market, they don't share that, as you can assume. Like, they just keep it to themselves. Like, for example, Jim Simmons, who I believe is the greatest investor of all time, his firm, Renaissance Financial, they have a certain fund which is extremely secretive, and that's the fund that returns about 50 to 60% every year, where like even the employees have to sign essentially contracts where they can't reveal the information
Wow.
that they're using to make these trades. So long story short, there are a lot of books, and there's books that I would recommend, but there's not a comprehensive one-stop shop book that I feel tells you everything. I feel you really just have to dive into it. You really have to get the experience. You have to back test. And you kind of have to get your hands dirty to figure this out. And once you do figure it out, then you can just make money off of it for the rest of your life and kind of keep it to yourself. But I really do feel that quote, "Those who know don't say, and those who say they know don't actually know." You know, those people who are going on TV, CNBC.
Maybe they're selling the book.
Yeah, exactly. You know, and you have to be wary, especially a lot of these YouTube people who are on YouTube saying, "Well, you know, do this, just do this. I'll sell you my course."
Right.
It's like, you have to think about their incentives. If they're actually making a ton of money, why would they care about your, you know, X amount of dollars?
$50 for a course,
exactly,
or $20, $50, whatever the case may be. But you see, the thing is, they appeal to people's emotions, right? They're promising the life that you're living right now.
Yeah.
I mean, to go into that, you're basically a nomad.
Yeah.
Are you not?
Exactly.
So you're free of, and next week you're going to go to Puerto Rico, right?
Yes, sir.
You're constantly traveling. I'm sure you were. You said that you were outside of the country a few months back as well. So I can understand why people would buy that $15, especially if the promise is that you can live the lifestyle Brian is living.
Yeah.
You know what I mean?
Yeah. Yeah. And to be honest, there really is no shortcut. Like, I wish there was, like, you know, a course or like a book you can read. It really is a discipline of just continual learning. Like, for me, this has taken, I formed the LLC about 3 years ago. So that was when I first started like learning about investing, first started doing my back testing 3 years ago. And luckily last year is I would say, the first year where I made a significant amount of money to like walk away from my job. So that was 2 years of testing, studying, training, figuring out the market, reading books. Like, it's not something that you can really just do in a week and be done, you know? And those individuals like myself who have studied it over so much time, odds are they're probably not just going to like wrap it up into a package and then just give it to you for, you know, a couple of dollars. You know, it's more valuable to keep it to themselves, because long story short, if you found a pattern in the market that nobody else knows about, and you just keep capitalizing off of that pattern,
You're done.
You can make a ton of money. But if more and more people find out about that pattern and they're able to beat you in terms of executing the order and selling the order, that's going to diminish your returns. So it's kind of counterintuitive to share some of that information, which is why I feel, you know, Renaissance Financial, like their Vanguard fund, their most prominent fund, is so secretive, because if more people find out about it, it's going to diminish their returns, and it's kind of counterintuitive. So no, I definitely agree. I think people tend to want the easy route and kind of want quick money. But I really don't think investing or trading is something that you can really pick up quickly. I really think, so I know a couple other traders, and every single trader I know has been doing this for years, and the biggest consistency that I've found in terms of successful traders versus unsuccessful traders is backtesting. Individuals who essentially go historically through a number of years and say, okay, if I were to do this strategy back in 2019, how many times would I have won? How many times would I have lost? What's the amount that I would have made? Things of that nature. But I really do think backtesting is the most important thing you can do when it comes to trading, because that's going to give you the confidence knowing that, okay, if I had done this yesterday, I would have made X amount. Therefore, I feel confident doing this today because historically this has worked more times than it has not worked. So backtesting really, in my opinion, is the most important aspect of trading and investing. So
Back testing. Is it in a particular stock that you're interested in that you would backtest, or is it just in the whole market? How do you backtest?
yeah, so I backtest essentially every stock that's over $200 billion. And the reason I choose those is because I like to trade, blue chip large stocks, and it also deals with the pricing. So these larger companies, the prices for the contracts are more objective. So there's this thing called spread. So spread is essentially what someone's willing to buy an asset for versus what somebody's willing to sell an asset for. And some assets, especially the lower caps, the smaller stocks, they have very large spreads. So like, let's say somebody wants to sell an asset for $10, but somebody's only willing to buy it for $2. That's like an $8 spread. So anything in between there, it can shift a ton. I don't like trading that because the value is not objective. The value can switch very quickly. But with large caps, the value and the spread are extremely small. So like somebody might be willing to buy something for $2.51 and somebody's willing to sell it for $2.50. That's only a $1 or a 1 cent spread, which is much more objective. You're able to calculate, okay, exactly, if this increases, 30 cents, I'm able to make X amount, as opposed to when the spread is larger, the value it can bounce anywhere in between that $2 to $10. So that's why I trade assets over $200 billion, is because they have very small spreads.
There's a statistical term for that, isn't there? When the gap narrows, your probability of having a higher return on your investments is higher.
Okay. Yeah. I definitely believe it. Yeah. And yeah, I pretty much only trade assets that have a very small spread. So I try to stay away from assets that have, like, for example, GameStop. The spread on those contracts were insane because the value is fluctuating so quickly that you might buy an asset for, like, I don't know, let's say $20 a contract, and then within 5 minutes it's down to $8 a contract. So you just lost over half of your investment in like 5 minutes. And that's because the spread is so wide, what people are willing to buy it for versus what people are willing to sell it for. It's very relative, and I completely stay away from those stocks. But with large caps, the spread is much smaller. It's much easier to do risk analysis. It's much easier to get in and get out of trades. That's why I trade assets over $200 billion. And long story short, I've back tested every single asset over $200 billion, and I've narrowed it down to 10 that have the highest percent accuracy with my trading strategy. And number one, like I mentioned earlier, is AVGO. That's the ticker of the stock, but it's actually Broadcom. And then Eli Lilly's number two. Those have roughly anywhere from a 70 to 80% accuracy.
When you say 70 to 80% accuracy is extremely high.
Yeah.
That is impressive.
Yeah.
So is your business geared towards maybe one day putting your platform as a product? But you did tell me that, like, if I put my platform on the product, maybe it's just that if a lot of people adapted and they're executing better than I am. I'm putting myself in a position where I'm actually, okay.
To be honest, so like I mentioned, Jim Simmons is one of my biggest role models, and like this dude, like once he figured it out, he kept it secret. So I'm kind of leaning towards the same, where I would open up a fund where individuals could invest with me, and then I would use my strategy to make them money, and I would take a percentage, things like that. But in terms of actually giving away the strategy and giving away the actual like programming, I probably wouldn't do that.
Yeah, it wouldn't be smart.
Yeah, but I can tell the audience that, like, long story short, on day trading, the statistics I rely most heavily on are linear channels and stochastics. I'm not going to give the exact settings and the exact parameters that I'm putting into it, but if you go and you backtest with linear channels and you backtest with stochastics,
let's define those two.
Okay.
Like, I mean, you're a statistician, so those terms make sense to you.
Yeah.
And to some extent, they kind of make sense to me as
Yeah,
well.
yeah.
But let's break
Yeah,
those down.
definitely. So linear channels for start, that's taking a linear regression of the closing price of an asset, and you're just making a linear regression prediction. So like, let's say an asset, was trading for $10 2 days ago. A day ago, it's trading for $20. Today, it's $30. So it's going up $10 every single day. That's kind of a linear channel where it essentially finds the line of best fit and essentially it plots that line of best fit through every single occurrence. And the occurrence is going to be the close, whether that's the close of the day, the close of the hour, the close of 15 minutes, but it's essentially plotting a line of best fit. And then the channel, it's essentially taking two standard deviations outside of that line of best fit based off of, how much the asset's actually moving to figure out, okay, what's the average deviation from that line of best fit. And with the linear channel, you take two standard deviations, and I believe according to the normal bell curve theory, 96% of your data is going to fall within two standard deviations. So I know that if my asset hits the bottom of that linear channel, there's a 96% chance that it's going to bounce back up and remain within the linear channel. And then I use stochastics, specifically the stochastic momentum index, which is a statistic that measures how far an asset is trading from its average price. So like we mentioned earlier, my personal thesis is that all assets in the short term return to their average price, and the stochastic momentum index helps me measure that. There's certain settings you can do for all of these. But long story short, I use my stochastic momentum index to tell me, okay, how far is this asset from its average price? So for example, with GameStop, let's say the average price for GameStop is like $10 a share. If it shoots up to $40 a share, my stochastics are going to be going insane, saying this is incredibly overpurchased. Odds are it's going to come back down towards the average. And that's kind of where my stochastics come into play. But
And that can range from on the right or on the left side as well, right?
yeah.
It
So
could
if
be
an
like
asset's completely under, odds are it's probably going to come back up, which is what I really enjoy about trading
Right.
versus equities, because you can make money as it goes up, you can make money as it goes down. But if you just do stocks and just do long-term investing, you can only make money as it goes up. You can't make money as it comes back down. So that's why I really like trading. But yeah, that's been my strategy in terms of back testing and in terms of the statistics. So.
I do want to take it back to you, Brian. Your story fascinates me. You basically were grinding in your early 20s.
Mm-hmm.
You were. Tell me the decision behind that, and with you being staying in your 20s, right now, you're actually progressing into a lifestyle where you feel like maybe this is something I do want to test out and explore and see what happens, right?
Yeah.
Tell me a little bit more about your lifestyle.
Yeah, definitely. So kind of work hard, play hard. That's always been my mantra. I've never been shy in terms of just putting a lot of hours into a craft. Before I was building this business, I was putting a lot of hours into bank examination. Like, it's actually a 3-year process just to get the title bank examiner, to get commissioned by the federal government, saying, okay, this guy can represent the federal government and has the authority to speak on behalf of the federal government. Just that training process is 3 years, and then after 3 years, you have to take a big test. So all of that to say, it was a very difficult process, and I think that's probably what got me accustomed to just kind of obsessing over something and studying it and being like, okay, and not being afraid to put in a lot of time into something, because that was 3 years I dedicated to just banking.
Postmasters, right?
Yeah, Postmasters.
That's crazy.
Yeah. So yeah, I think that's kind of what got me accustomed to, okay, this might not happen tomorrow, it might not happen next week, but it's probably going to happen eventually, as long as I keep with it. I think that's probably what kind of instilled that confidence in me, is kind of that whole, working for the Federal Reserve and going through the bank examination process. I definitely do think it did happen with trading. Like I mentioned, it took about 2 years for me to really figure this out. But now that I have it figured out, it's been pretty consistent. So
That's lovely, man.
But yeah, that's kind of my background, and that's kind of I feel what really helped me have the confidence that as long as I stick with this, it's probably going to work out. Plus, I had some success along the way, which really helped me believe that I was on the right path. So like, when I first started, I would make a bit of money and then I would lose a bit of money. And then I would go back and analyze it and be like, okay, why did I make money this time? And why did I lose money this time? And then I would figure out the differences. And then I would, try never to make the same mistake again, and then do it again, and just keep learning and learning and learning. And like I said, over time, I had success, but I also had failures. And the thing was just to learn from those failures. And as long as I was successful, it gave me the confidence that I was on the right track. I just had to fine tune it. I just had to figure out, okay, in this situation, this might not work, versus in this situation, historically, this always works. So the fact that I had success along the way really gave me the confidence that I was on the right track. So.
How do you factor in unpredictable variables that come in and surprise you sometimes? They do happen, like you said, right?
Yeah.
Wars can break out and presidents can die and different things can happen. But how do you factor them into like the normal model that you're going to train?
Yeah. So to be honest, they're just kind of unavoidable. To be completely honest with you guys, you're probably not going to win every single trade. Like one thing that Jim Simmons said that I really appreciate is the goal isn't to win every single trade. The goal is to essentially minimize your losses and let your winners run. So for the trades that I lose, I cut them off early. I cut them at 10%. But the trades that I win, I'm going to let them run. So I'll let it run to at least, 30%, but maybe it goes higher. Maybe it goes 50%, maybe it goes 100%, which I've had some of those trades. But the biggest thing is to cut your losers early, because things can happen unexpectedly. Actually, just a few weeks ago, I was trading this pharmaceutical company, Eli Lilly, actually. And long story short, the technicals, were good. Everything was looking really good. I was essentially going to make purchase an option contract that was going to say the asset was going to go down, because that's what the technicals were saying. But later that morning, it actually came out, news had come out that, their weight loss drug was actually approved in China, which, you can't really find information about Chinese government. Like, they don't really make that public. They hide a lot of their data. So there's certain things that are just unpredictable. And I feel like that was one of the things that was unpredictable. So their weight loss drug, which I think is called Wegovy or something, was approved in China, which has the largest consumer market, which of course is good news. Like, they just got, potentially a couple million new customers. Unexpectedly, the asset shot up. When I was making a bet that the asset was going to go down, which you really can't predict things like that. But what you can do is cut your losses early.
Quick.
So once you're down 10%, just get out, move on. You lost the trade, and just move on to the next one. And like I said, as long as you're making more money on your winners than you're losing, then you're going to be profitable. And that's the goal. The goal isn't to make 100 trades and win 100 trades. The goal is to make more money than your losers are losing, essentially. So,
if you feel comfortable discussing this, if not, I totally understand. How much kind of, not you necessarily, I'm not putting it, how much do you make, but how much kind of person who is a full-time trader with the tools that you currently have could potentially make? Give me a range.
A shit ton. So I like to think in terms of percentages, but in terms of dollars, like, you can make a lot, especially in a day. So for me, the minimum I want to make every single day is roughly about 10%. Ideally, I like to make 30%. That's where I'm going to close it out and be like, okay, this is a good trade. I made my 30%. I'm done. So let's say you start off with $1,000. I think that's pretty realistic for most people. You can, in theory, make about $300 a day, but realistically at least $100 a day, roughly $100 a day. It might be 3 times a week, it might be 2 times a week, but roughly about daily. So yeah, with that, it really just depends on the percentage. So with my percentages, it's anywhere from 10 to 30% is what I'm really trying to make every single day. And with that, you can make quite a bit. So for me personally, the best month I've ever had was back in September. And back then I was making about anywhere from about 50% a day. So it was quite a bit in terms of the invested capital return. But I'd say anywhere from 10 to 30% is realistic. And I do know multiple individuals that do this full time, like myself. Obviously, they've actually been doing it way longer. So I know some people that are like retirement age, and they actually trade out of their retirement account and just do that full time and make a ton of money. But yeah, you can make a lot. It really just depends what you're willing to invest into it. So like I said, if you invest $1,000, you can expect to make anywhere from roughly $100 to maybe $300 a day, realistically. So.
How do you see that as a business? How do you formalize the structure as a business, right? I mean, you're putting money in. So is the capital injected considered as capital injection, and the return that you get, that will be, I guess, considered as a gross profit. And then are you deducting expenses of your living expenses, or maybe like you can consider yourself as a an officer, and then you have
Yeah.
an officer salary. Is
Yeah.
that how you structure and run your business, like a regular LLC, who's doing trucking, for example,
Yeah.
is running it?
Yeah, it's pretty similar. I mean, you can do it through an LLC. My specific trading business is an S corporation, so technically I'm an employee of the corporation, and then I kind of give myself a salary. But yeah, it works like any other business where you have your expenses, you have your income, and you kind of just go with that. Um, One of the big things that I plan on doing once I actually open up to the public and take on public investors is, essentially treating it like a hedge fund where, individuals invest with me. I make them a certain return. Out of that, I take 20% of whatever I make them, and then there's a 2% management fee. That's pretty average for most trading firms. It's called like a 2 and 20, where 2% just to manage your funds, and then 20% based off of the profits that I make you. So let's say, I make you, let's say 100% return over the year. You're going to keep 80% of that, and then I'll take 20% of that.
Fair deal.
Yeah. But yeah, that's pretty normal, and that's kind of the plan. So if everything keeps going as planned, I plan on becoming a registered financial advisor by the end of the year. That way, I can actually take individuals' funds and kind of invest on behalf of individuals, and kind of open up the firm to the general public. But yeah, to answer your question, it's pretty similar like any other business. This specific business that I have, though, is an S corporation, but
Makes
you
sense.
can do it through an LLC if you'd like. I just feel like from a tax perspective, it's a little bit more advantageous to kind of do it through an S corp and kind of go this route than an LLC. But they're pretty similar. So
Yeah, very, very fascinating. I don't see myself trading my money necessarily, but I know if you were to open up your firm,
yeah,
I'll probably be one of the first 10 people in
love
line.
it, love it.
you know,
Yeah. You'll be the first person I text. So.
yes, please do, please do.
Yeah.
Because you do have the background and also the understanding and also emotional maturity to be able to actually really test it out yourself for a couple of years before you can say that I can take people's money. So
Yeah.
you're not quick with it, and you're
Yeah.
taking your time and you're being patient. So I think that kind of speaks to your character.
Yeah.
And you're my friend.
Yeah, likewise. Yeah, no,
Um,
I'm not really in a rush. I think that's the biggest thing. Actually, I think it was like Bill Gates in one of his autobiographies. He was talking about how he grew up with a bunch of his friends, and how they were all very entrepreneurial, and how they were all trying new businesses. And he talked about essentially he had two friends. One of his friends actually ended up going dead broke, and the other one actually ended up becoming extremely wealthy, very similar to Bill Gates. And he was talking about the differences between his two friends and why he believes one ended up going broke and one ended up becoming extremely wealthy. And he talks about how him and his friend who became wealthy, they both believed that they were going to be wealthy. So there wasn't a rush. They didn't really take stupid bets. They didn't trade meme stocks or, like just, these random, extremely high risk investments. They were just like,
GameStop.
yeah, GameStop, things like that. They didn't really do anything like that. They kind of just took the slow and steady path. They're like, hey, realistically, as long as we can just make a 10% return over time consistently, like we're going to make a lot of money over time, as opposed to their friend who was kind of shooting for the moon and really was taking extremely high risk, high reward investments and gambles. And he kind of attributes that to why this individual ended up going broke, was because he was impatient. So for me, it's very important to not be in a rush, to not force this, to really take my time, and to really make sure that I'm certain in the direction that I'm going. So,
Yeah.
I definitely think it's important to be patient and to not rush this. So,
Yeah. Last question. What do you think about crypto in this space?
I actually do like crypto. So I actually do trade crypto. I swing trade crypto over the long to medium term. Specifically, I like two cryptos a lot, Solana and Polkadot. Those are the two cryptos that I've primarily traded and made money off of. I don't really trade any other crypto just because, very similar to stocks, I really only like to trade the largest cryptocurrencies, very similar to the largest stocks. And both Solana and Polkadot, I believe, are top 10 cryptos in terms of market cap, so they're not going to disappear overnight. And I've back tested each of those, and they follow my pattern, or they follow my strategy pretty well. And I know what the accuracy is. I can kind of predict it. So yeah, to anyone interested, I would definitely recommend those two cryptos. I don't really trade anything else. I don't have a problem with the crypto market, especially since it's similar to stocks in the sense that if you invest $1,000, there's no expiration. So if you just hold it for a couple years, in theory, it could, let's say you lose 50% the first year. Let's say, you hold it for another 10 years. In theory, it probably could come back up to, $1,000. There's no expiration date on it. You can just hold it for as long as you like. Very similar to stocks. So I like crypto. I'm not against crypto. I wouldn't invest my life savings into crypto just because it's a bit too volatile and unpredictable. But I do like crypto specifically. Polkadot and Solana are the two that I really like, and those are the only two cryptos that I trade. So.
Yeah, I am very interested in Cardano,
Yep.
but I don't trade it. What I do is I buy and hold.
Yeah.
Buy and
yeah.
hold long term.
Yeah.
So I would hopefully and potentially see the results in the next 20, 30 years. Is
Yeah.
my hope. So
Yeah. And
just
it's
slow little investments that I throw in
Exactly.
here and there.
And
And
it's
if
like
it was
what
to be a loss, I would consider it to be maybe a subscription that I would pay for like a service. You know what I mean?
Yeah.
So
Completely agree.
I
And that's the way
wouldn't
to
be-
do it, slow and steady, just over time, putting a little bit. And I feel like that strategy is almost identical to kind of what most people do with the stock market is that they put a little bit and a little bit into the S&P 500, maybe every month, every paycheck, things like that.
Yeah.
And then over time, you have a ton of money. I actually have some friends that have done that where, ever since they graduated college, they've just been putting in a little bit into the S&P 500, a little bit every single month, and it continues to grow, and they're doing really well. And they're planning on retiring here in about 3 years, so
Wow.
they're doing pretty well. So.
And travel the world with you.
Yeah,
Right
they
now.
can't come. No married people. It's too
Oh,
they're
I
too
see.
boring.
A
They're
little,
too boring.
a little too late for that for them.
Yeah.
But I appreciate you. Thanks for being here.
Yeah, likewise, man. This was
Yes,
a blast.
sir.
This was an
Appreciate
absolute
you.
blast.